For decades, you kept your receipts, handed them to an accountant in January, and moved on. That system is over. Under Making Tax Digital, HMRC requires self-employed workers and landlords to submit income and expenses 4 times a year. Ignoring this new schedule carries a high cost. Every missed quarterly deadline earns you a penalty point. These points accumulate across the year, and once you hit the threshold, you trigger an automatic £200 fine. To get you ready, we will calculate your exact mandatory start date, establish a clean data tracking system, and eliminate the hidden software errors that trigger HMRC audits. Your first step is to pull up your last completed tax return. Find your total gross income figure. We need this specific number to determine when the new laws apply to you. Setting up a proactive digital system right now means you won't be caught off guard. You trade the stress of a looming deadline for a simple, streamlined quarterly habit. MTD eligibility is triggered strictly by your gross income, every penny received before expenses are deducted, not your net profit. If that gross figure exceeds £50,000, MTD is mandatory starting April 2026. Over £30,000, your start date is April 2027. Once you are in the system, HMRC mandates 4 fixed quarterly reporting deadlines, due on the 7th of August, the 7th of November, the 7th of February, and the 7th of May. Open your calendar app right now. Create a recurring event exactly 30 days prior to each of those 4 dates. This gives you 4 weeks to review your records without deadline pressure. Locking these exact dates into an automated calendar ensures you always have adequate preparation time. You eliminate the risk of late submissions and keep your penalty points at 0. The absolute prerequisite for MTD compliance is a dedicated business bank account. Every business receipt goes into this account, and every business payment comes out. Running a business from an account that also pays for your groceries creates massive compliance risks. Software will inevitably mix personal and business expenses, which HMRC data analytics flag for an audit. Record income correctly. A client pays a $500 invoice, the processor takes $10, and your bank shows a $490 deposit. You must log the full $500 as gross income and record the $10 fee as a separate expense. Real business expenses rarely end in double zeros. A software subscription is $119.88, not $100. HMRC's risk profiling system flags submissions filled with round numbers because they appear estimated. Logging exact decimal amounts proves your data is backed by actual receipts. Finally, you must reconcile your invoicing platforms with your bank feed every month. If your software logs an invoice as paid and the bank feed imports the same payment, you will double count your income if uncaught. Applying these rigid data entry rules ensures the raw materials feeding into your quarterly updates are structurally sound and ready to pass a compliance check. Accounting software categorizes transactions based on the average behavior of millions of users, many of whom make mistakes. It does not read HMRC guidelines. Accepting auto-suggested categories blindly embeds errors directly into your records. Run a specific monthly audit to catch this. Filter your software for vague default categories like other business expense or miscellaneous. Review each transaction individually, reassigning them to the exact HMRC-approved category they belong to. Pay close attention to the difference between day-to-day running costs and capital assets. If you buy a new laptop, software might categorize it as a general expense. That is a capital asset. It belongs in your year-end adjustments, not your quarterly revenue expenses. HMRC requires you to meet the legal standard of taking reasonable care. Because you are personally responsible for errors, not your software, actively auditing these categories is the only way to satisfy that requirement. A quarterly update is not a tax return. You are not calculating your final tax bill or claiming personal allowances. You are strictly transmitting your category totals for that specific period. Cumulative reporting stacks your quarters. Submit quarter 1, quarter 2 drops directly on top to send the year-to-date total. If you correct a past error, the adjusted total automatically flows into the stack for your next update. After your 4th quarter, you hit the year-end adjustment phase. This is when you compile capital asset purchases, calculate apportionments for mixed-use expenses like your home office, and hand the final data to your accountant. Treating the quarters as cumulative data blocks means your year-end process is simple. rather than a massive reconstruction of 12 months of missing receipts. You now have a dedicated business bank account, a clean software routine, and an automated calendar. You have architected a system built for clean compliance. By maintaining this continuous tracking system, the actual process of submitting your quarterly update is reduced to a few minutes of verifying totals and clicking submit. You never have to spend another January frantically sorting carrier bags full of faded receipts or worrying about an unexpected tax bill. To get started right now, click the link in the video description. You can download the exact digital record-keeping templates required by HMRC to begin logging your income and expenses correctly today. Stepping into Making Tax Digital gives you a permanent, accurate financial picture. You are taking absolute control over the financial reality of your business.